Hello and welcome to another edition of the China Global South podcast, a proud member of the Sinica Podcast Network. I'm Eric Olander, and today we're going to give you a pulse check, a health update of the Belt and Road Initiative. Now, regular listeners of the program will remember that for the past year, at least for the past year, even longer maybe, we've been talking about this new, more austere that Belt and Road. It's gone on a diet. Basically, what we saw with Belt and Road spending was up till about 2015, 2016, it's been on this steady decline down. And we heard this reference to 小而美, and 小而美in English is small but beautiful. Some people said it was small and beautiful. But what we heard was small is sub $50 million projects. And a lot of this we heard was becoming because both the Chinese themselves and the borrowing countries were financially strained. We heard that the Chinese economy today is not what it was in the mid-2010s or the early aughts. And so they didn't have the money to go out into the Belt and Road and to lend vast amounts of money to borrowing countries who now, today, are facing quite a few debt sustainability issues, particularly in places like Africa. So we heard that there'd been a big drop-off in Latin America, big drop-off in investment and construction contracts in Africa, and that they were really focusing much more on the periphery. That is Central Asia, Southeast Asia, and even South Asia in Pakistan. That was what we heard for the past year or so. And then we got a report that came out recently from Australia's Griffith University and the Green Finance and Development Center in Beijing. And these guys have been putting out data on the Belt and Road for a number of years. So in many ways, they are the most authoritative source outside of what we get from the Chinese government itself, which is oftentimes not as consistent as this kind of data that we're getting from Griffith University and the Green Finance Development Center. Let me just run through some of the highlights of this, and I'll tell you, I was blown away from what I've been in this business long enough that doesn't happen very often, but this really just blew my mind. So the first half of the year, they're talking about January and the first 6 months from January, saw the highest BRRI engagement for any 6-month period with $66.2 billion in construction contracts and $57.1 billion in investment. Just some perspective, those two together are more than what happened all of last year in 2024. So there's been this huge uptick. So let's take a look at where all of that money is going. Energy-related engagements in 2025 were the highest in any period since the BRI's inception in 2013, reaching $42 billion, again, just in the first 6 months of the year, which is an increase of 100% compared to the same time last year. Oil and gas engagements surged to a record high of about $44 billion, higher than all of 2024. Green energy engagement reached new records as well, with $9.7 billion in wind, solar, and waste-to-energy projects, with installed capacity now at almost 12 gigawatts of green energy. And the metals and mining sector reached new records as well, also surpassing 2024. So altogether now, if you add up all of the spending cumulatively in aggregate of what has happened over let's see, just more than 10 years of the Belt and Road, $1.308 trillion since 2013, $775 billion in construction, and $533 billion of investment. Those two combined make up $1.3 trillion. Astonishing numbers, records all around. This is not what we thought we were going to get in the small but beautiful era. Let's bring our old friend of the show, Christoph Nedopil, who is the director of the Griffith Asia Institute and a professor at Griffith University in Brisbane. He's also a visiting professor at Fudan International School of Finance at Fudan University in Shanghai, and the acting director of the Green Finance and Development Center that is also at Fudan University. And Christoph, he is one of the authors of this seminal report. Christoph, a very good morning to you in Australia.
Good morning, Eric, and great to be back here. Thanks so much for having me back.
Wonderful to have you back. I'm very excited to speak with you. As soon as I saw these numbers, I reached out right away and said, I got to talk to you and I got to find out what's happening here. This, again, is not what we expected. You told the Financial Times in their coverage of the report that the surge in Chinese engagement was also a surprise to you. Multiple mega deals exceeding $10 billion. How do we reconcile what you reported in this update and what we thought we were going to get in the small but beautiful era?
Yeah, I think you're touching a very important point. So I think actually, by the way, we talked about it. The official translation, as far as I know, for CRMA is small yet beautiful.
Yet beautiful.
The yet is a great, because the and or but, which one is it? I think yet captures it perfectly. Actually,
it does, but it's not as literate in English. So that's why we've seen small and, small but, small yet. So, but it's art, yeah. So it's technically moreover. But yes, it's a good point.
But I think. So the small yet beautiful mantra really was a mantra of the COVID era, when I think there was a lot of question marks about how we progressed with the Belt and Road Initiative engagement. There was challenges of making deals just because of logistics impediments. There were sovereign debt issues in many countries. And so the model that we've seen in the first years of the Belt and Road Initiative of large public infrastructure projects that are financed through debt financing were just not possible anymore during this COVID era. And I think there was a lot of emphasis on the Belt and Road Initiative is not dead, because I think both a lot of BRRI countries and observers were wondering what's happening with the Belt and Road Initiative during COVID or after COVID. And so the emphasis was that BRRI is not dead. There's a lot of small yet beautiful projects that are going on, and we are pushing those forward. Now, we are obviously a few years past COVID, and we've already seen over the last 18 months, for sure, that project sizes, so the size, the kind of engagement volume through investment or construction in projects have been creeping up again, which is not a bad thing, but there has been a shift in terms of what type of projects are getting these large volumes in investment or construction contracts. And typically, so in the olden days, it was often projects, again, there were public infrastructure. There was, of course, also energy projects, but including roads and ports and railways, that some of these projects did not have really a strong enough business model. And therefore, the debt servicing was very difficult on some of these projects. And that's also what led to some of the criticisms of these projects. Now, what we're seeing now is actually a lot of resource-backed mega deals or actually investment. So we had this $20 billion construction project in Nigeria on kind of the exploitation of a gas park. And that's clearly a resource-backed deal where there's most likely sufficient cash flows from that project itself to pay back any loans that are taken. And then I think what's really interesting over the last years, which we've been observing, is that there is more willingness from Chinese investors, companies, to go into BRRI countries and use their own money to invest. And this is also partly including a couple of pretty large deals, particularly, again, in kind of very strategic areas, particularly around metals and mining.
We're going to get to the corporate side of this in a moment, but let's get to this resource for infrastructure deals, because in many ways what you're saying is back to the future, because when China was first going out, they created something called the Angola model, where China, again, when we talked about this in a recent show with Brad Parks and the team from Aid Data about how they collateralize their loans, and resources oftentimes is used as collateral, as you've talked about. So they'll give a loan. If the borrower can't repay it, they'll take revenue from the sale of oil or from the sale of an asset and then repay the loan that way. So it seems like that's becoming more fashionable as well. But this idea of using resources as collateral has been very controversial, in part because they will negotiate a price for, say, oil, and then the oil price changes, and then the country is stuck sometimes with a contract where they agreed a price of oil at 70, oil's at 100 now, they're not getting as much for it, and it gets very complicated. These loans fell out of fashion for a long time, or these financing mechanisms. They're not all loans now. Is that how they're doing these resource for infrastructure loans, or is it using it more as collateral? What's evolved since those Angola days?
So I think what is different from the early phases, and kind of that a lot of the original deals kind of that I was talking about, like road and railroads, don't even kind of make enough cash flows to really pay off.
Well, a lot of them didn't make any cash flow. They would just be infrastructure for social benefit that wasn't tied to a revenue-generating
Absolutely.
initiative.
So that's always the issue with public infrastructure. Like we know it from any country. Most of our roads are public infrastructure, are not cash generating. There are economic value creation for sure. So ideally, we are unlocking transportation infrastructure, but for the road itself or the asset itself, it's not cash generating. And so how do we pay that back? And that used to be, of course, through tax revenues, because we promise higher GDP growth. And with higher GDP growth, you have more tax. And with more tax, you can pay back the debt. And that didn't work.
Yeah, that's a long cycle, though, right? I mean, it takes decades sometimes to generate those returns.
That's right.
And those loans are due in years, not decades.
That's right. And so what we're seeing now, kind of far less of this infrastructure. So we've seen kind of a real scaling back of this public infrastructure that has no revenue model. And what we are identifying more is not this resources for infrastructure, but actually a construction of a specific park, for example, in Nigeria, and as well in others, that is directly tied to the gas or any underlying resource that is getting exploited. And the exploitation or the sale of these resources generates revenues, and typically sufficient revenues to pay back any debt in the construction contracts. So it's a little bit different from a resource infrastructure deal where you're tying a absolutely separate infrastructure to a resource deal. What we are seeing actually is just purely we are exploiting the resources, and this has sufficient underlying assets.
So the focus, if I understand you correctly, is they can build something, and the moment that it launches, there's revenue coming in. So I can think of a telco network, for example. They can start monetizing that right away with a telecom network. We've seen the Phnom Penh Sihanoukville Expressway and the Nairobi Expressway. These are toll-based. These are done as public-private partnerships. The moment it opens, people start paying money, and they can start to recoup that investment. Oil, obviously, is one. Energy is one. So we should be looking at projects that have an immediate return on investment that starts very soon after the project launches.
That have a return on investment is always more difficult, but that have an immediate cash flow.
Okay.
That suffices to actually service the debt and pay off the contractors.
So public good infrastructure. So Lusaka in Zambia needs a new sewage system. That is a public good infrastructure, but it doesn't necessarily generate revenue. That kind of infrastructure, the Chinese are not as interested in because it would require debt financing, and a country like Zambia is not in a good position right now to borrow in order to pay for that kind of infrastructure. Is that correct?
That is typically a lot more risky, these projects, and so they'd have to find different mechanisms to have credit enhancement in order to allow for any construction company to actually take on these risks, yes.
Yeah. The immediate thing that I got, this reaction from several people when I showed them your report, was obviously tied to the current moment that we're in, where they see this surge of Chinese engagement on the BRI at the same time as not only the United States, but also Germany, the United Kingdom, France are pulling back on their development budgets. Is there any correlation between the data that you collected in the first half of 2025 and this moment that we're in? A lot of people want to see, and I don't know if it's true or not, but they want to see a correlation that the Chinese are seeing this as an opportunity to push ahead while the US and European countries are pulling back. Or is that assigning a conspiracy or assigning an agenda that just it's coincidental, but it's not relational?
So I think it's difficult tell. My gut feeling is that it's a little bit coincidental. I think a number of these big deals that we've seen in the first half of 2025 are not deals that you sign very quickly. These typically require some feasibility studies and negotiations. This is not something that you do in weeks or maybe not even months, but it takes quite a lot of work to actually get such a deal over the line. So I think that's number one. I think it's also important not to conflate the BRI, which is a lot of actual private companies, Chinese private companies that are going out there and taking risks and are interested in investing abroad with development finance from Europe or from the US. So I think there's also just a very definition difference between what the BRI is and what, of course, the Western development aid is. There is development aid from China. I think that is very different from the Belt and Road Initiative that's coming from Sitka and that's coming through the Global Development Initiative. But the BRI is much more commercial than development.
Well, I think it's difficult for a lot of people, in part because the definition of the BRI sometimes is a little bit ambiguous. We don't know if this is just a deal or if this is a BRI deal, or maybe it's both. But you've talked about corporate actors and private companies that are engaging in this. What percentage or what share of what you've seen in the first half of this year of these deals and this investment in the construction contracts that you tracked are being led by Chinese state-owned companies that have all those resources of the backing of the China Exim Bank, the China Development Bank, Sinosure, that big infrastructure of Chinese finance that really propelled the Belt and Road in the first phase of its life, compared to private companies like Huawei and Hisense and others that are going out and doing a lot of these deals? Tell us a little bit about the breakdown between private and public companies.
Yeah, I think that's a great question. Let me just also kind of take one step back, because you mentioned it, kind of how do we actually think about what is a BRI project? And I think there is no official definition. There's no official label that any institution in China gives to any project, whether you're a BRI project or not. And so the way we have defined BRI projects for the last 6-7 years is to say any project by a Chinese construction company that is with significant involvement, or of course a Chinese investor, in a country that has signed an MOU with China to collaborate under the Belt and Road Initiative. And so countries, even kind of, I know of some projects that claim to be Belt and Road Initiative projects in Spain, which is officially not a BRI member, but Portugal is a BRI member. So we would consider Portuguese projects a BRI project.
Does that mean if a Chinese toilet paper company opens up a factory in Portugal, that's a BRI project?
Under our definition, yes.
Oh, okay. Even though it has nothing to do with connectivity, infrastructure, telecom, green energy, it's toilet paper, but still that's a BRI project.
Whether it's toilet paper or EVs or what have you.
Interesting.
It is,
okay.
Yes. So it is just because kind of the countries have on kind of country level agreed to collaborate under the Belt and Road Initiative. And there is, again, no official definition. And so our clearest, most consistent definition is any projects in BRI countries we count kind of as Chinese BRI investments.
Okay. Well, let's go through some of those actors. Maybe they're not toilet paper companies, but who are some of the private companies that stood out in your research and looking at this data as big actors? You talked about these multi-billion-dollar deals. Who should we be paying attention to?
So yeah, I think what's clear is that over the last years we've seen strong engagement by non-state-owned enterprises, so private actors from China. And that includes a number of different sectors. That's the mining sector. The mining sector is partly significantly privately held in China. So you have Zijin mining, you have a couple of other mining companies. You have in the technology space, that's including in the EV space or in the battery space, you have companies like Cattle that are investing in other countries. You have in the kind of mining processing space, so East Hope Group. They are kind of aluminum and other metals. So these are private companies that have been extremely active in the BRI.
Can I just ask you one quick question about these private companies? Because there's a lot of confusion in terms of where the line is between private and public. So they are oftentimes listed on the Hong Kong Stock Exchange, the Shenzhen Stock Exchange. They don't have any state backing in the company themselves, but they oftentimes benefit from state-backed financing and this infrastructure of financing that's out there, things like Sinosure and other financial tools. When you talk about these private companies, are they acting 100% in a private capacity, or are they leveraging this financial infrastructure that is very much public and state-backed?
So I think there's a lot of similarities all around the world, whether you're a US company investing abroad or a German company investing abroad. You typically get government support through insurance provision, through export guarantees, through export financing. That is typically state-backed. So from the German side, I think KfW does a lot of support for private companies abroad. And so the Chinese do a similar thing. They have provided export credits, they've provided export insurance, also through their to their private actors. So it's this state financing is not only available for state-owned enterprises. This is also available for private companies. But again, this is not something that the US,
unique to
or
China.
Germany, or anybody else would not do similarly in order to support the export model of their own country.
Okay. Well, where is all this action happening? As I mentioned in the beginning of the show, a lot of the assumption was that China was going to pull back from some of the regions that are further afield, like Africa and the Americas, and focus more on its near abroad, Central Asia, Southeast Asia, and South Asia. Your data showed partly that's the case, but also not entirely the case. Tell us about the regional priorities that the Chinese seem to have right now, at least in the first half of the year.
Yeah, it's so interesting, kind of, Eric. I've been listening to you guys' show, and kind of you and Kovis have done and kind of the whole team now have done such a good job, and kind of always trying kind of to kind of have your finger on the trends. And so kind of whenever I see kind of the strong engagement by China in Africa, it's like, oh, that's very much against the narrative that we sometimes hear, that there's a pullback from Africa. So particularly in the first half of 2025, we actually saw very strong engagement in Africa. One of the reasons is, again, kind of this massive deal in Nigeria that we found, but also I think other regions that have over the years become a lot more important is the Middle East. That has been very consistent over the last 3 years. That Middle East took a very central role as a kind of recipient of Chinese BRI engagement. What I think is interesting is the engagement in Central Asia over the last years, which has been very consistent. And now kind of it's just kind of exploded due to some mega deals in Kazakhstan. But overall, I think there's a clear kind of interest from Chinese companies to engage in Central Asia. What's not so surprising is Southeast Asia. There's kind of always been relatively good engagement in Southeast Asia, just because it's as you mentioned, the near neighbor, and there's a relatively easy outsourcing of some of the production processes to neighboring countries like Vietnam or Thailand or Malaysia. So we're still seeing this, but overall, I think there is, no clear loser. I think overall in 2025, it's been very strong engagement across all regions except maybe Latin America.
Yeah. Well, Latin America did come up as a clear loser. You wrote that Latin American BRI countries continue to see low Chinese engagement, remaining the lowest values in the past 10 years for investment and construction. That is a big surprise to me, given the interest that China and Xi Jinping himself has in countries like Brazil and the new Chancay port in Peru, and the emphasis in that the Chinese are putting on South America for trade that is going to offset some of the things that they're not buying from the United States anymore, like soybeans, for example, and as a huge new market for Chinese EVs in countries like Brazil. Did that Latin American number surprise you?
I think they have been consistently lower than probably kind of the narrative sometimes suggests. It's not something that where we've seen over the last years such a extreme engagement in Latin America. And Latin America we're also only looking at BRI countries. So Brazil would not be kind of covered in our report.
That's
because
correct.
Brazil is not yet
Brazil.
it's not a BRI country.
It said it's open to it, but it's a controversial issue in Brazil about whether or not to join the BRRI.
That's right. I mean, the question for Brazil is what's in it for Brazil. They're already receiving quite a lot of engagement from China, even without being part of the BRI, and there's obviously collaboration also via BRICS and other formats.
Yeah. Africa, just according to your numbers, $39 billion of construction contracts and investment. 21 billion of that, of course, is concentrated in Nigeria, as you talked about, on some of these energy projects, also some railroad construction going on there as well. Central Asia, $25 billion. So those are the areas to watch. It's just interesting for me that we're talking about this again at this time when the United States, and even to some extent Europe, is ramping up this discussion about competing with China in these strategic areas. I'm thinking of critical resource mining, obviously new energy. Oil and gas is something that the United States really sees itself as a major player, given that it's the largest oil and gas producer in the world. Again, your report, with no disrespect to you, literally went unnoticed in Washington. I did a survey of people on Capitol Hill, at the State Department, at various. And I said, have you seen these numbers? And they said, no. And what they told me was, Eric, nobody cares here. Nobody cares. You're talking about facts on the ground, Eric, and we're talking about narratives. And I was like, oh, right. Okay. But anyway, let's say somebody in Washington did care. What's the message here? That what I took away was that China in these critical areas is very much pulling away to the point where it's going to be difficult, if not impossible, for any other country, whether it's Japan or South Korea, or the Europeans or the Americans, to catch up in some of these areas, given the scale of what we're talking about, hundreds of billions of dollars.
So it is, I think, one of the things that potentially also drives some of the opportunities for China to engage in the BRI is consistency. So over the last 12 years, since 2013, definitely, I think this strong narrative from China, and of course also kind of the analysis that you do and others are doing, and that also provide kind of some perspective about the Belt and Road Initiative, has allowed China to build a more consistent approach to engaging in some of the BRI countries, many of which are not easy countries to do business in, and where a lot of Western companies are also not willing or able to take the risks in doing these businesses. And so I think this is an advantage from the Chinese, that they have been able to really build over the last years, to build these experiences to work in some of the difficult countries. And of course, also the willingness of some of the Chinese companies to also not be dogmatic about some, I think, environmental and social and governance issues that are very important for Western companies, and I think also for good reasons. But I think this allows them to pull ahead in some of the countries that are resource rich or are potentially also quite strategic. And I think that the second point is not only that they know how to deal with risk, but also then that the BRI countries themselves say, like, who's actually a reliable partner who we can invite to help us build a new industrial park or exploit our resources with us together, because they have done it in a different country, they have done it here already, and they seem actually quite experienced and be able to deliver. So I think this is actually, the consistency around it is extremely important. And so the narrative coming from the US and Europe, which is, of course, important and potentially provides some alternatives to many countries in the global South. The problem is kind of, are you providing consistency in your approach to your engagement in these countries? Do you have the tools? Do you have the financial tools? Do you have the insurance tools? Do you have the construction companies? Do you have such a package that is able to deliver as quickly and as reliably as the Chinese?
Yeah, they oftentimes have the tools. They just haven't had the success in bringing them together. So the Europeans and the Americans have an Exim Bank. They have development finance institutions like the DFI, the Development Finance
Corporation, DFC.
Yeah, DFC, that's right. And they have a lot of these different tools, but coordinating them to the level that the Chinese are able to coordinate them seems to be a pretty significant challenge for a lot of these governments that are seeking to rival the Chinese in these areas. Now, we've talked
to that point,
go ahead.
Eric, just kind of, I mean, the DFC is an interesting example because the DFC is very political in the end. And so kind of you have a change in government and the priorities of the DFC will change. And so kind of this consistency about your approach is just more challenged if your strategy of your development finance institutions changes every couple of years.
Yeah. And it certainly changed under this administration to be much more focused on transactions, less focused on empowerment and minority businesses and women-owned businesses, which was very much the priority in the Biden administration, and also funding those areas that the private market wouldn't fund. And DFCs today is doing something very different on that. So we've talked about who the actors are, the different companies. We've talked about where they are doing all of this business. Now let's talk about what they're doing and the different sectors that people should watch out for as where BRI activity is most intense. So green energy, oil and gas, mobility, these are areas we talked about. Can you kind of break down some of the sectors that people should watch out for keeping a track of going forward as to where the activity is?
Right. So the activity is very concentrated in, I would say, 3 sectors, which is different from what we've seen before. So the 3 sectors are energy, metals and mining, and technology. So the old BRI was very focused on transport and energy. So energy has always been important. The energy remains important, although there has been, of course, a shift towards more kind of green energy overall. So even though kind of we've seen this massive increase in gas, we've seen more green energy than ever before.
But within green energy, is there a favorite that they like? Solar, wind, hydro? Which one of these gets more attention, or are they all pretty much equal?
So the solar and wind is actually pretty equal. And it's important to understand kind of just always putting that out there. We are tracking construction and investments. There's a lot more export of Chinese solar and wind capacity than what we are tracking. So that these are exports is very different from the construction and investments that we are tracking. So it's a lot more renewable energy that kind of the Chinese solar panels are powering than kind of what we are tracking, just because the export is not part of kind of what we are tracking. But yeah, solar and wind are actually both quite well kind of served, which is interesting because wind has been over the past years a little bit under the radar. It's been not as well kind of utilized, but now we're seeing also a growing kind of engagement in wind. We're also tracking across, particularly in the energy supply chain, what is actually happening, because there's a huge difference whether you are exploiting gas or oil or even coal compared to generating electricity or transmitting electricity. And so we are seeing actually significant amounts of electricity generation, which is important. We've also seen more, again, this in the first 6 months in the distribution sector. So distribution is very important if we want to accelerate our energy transition. We need more transmission lines to transport the new electricity from wherever it's produced to where it's needed. And so these are important kind of investments that are needed, whether it's from China or somewhere else. So that's kind of in the energy space. The technology and manufacturing space, we've seen over the last years kind of really, I think, very, very fascinating, this strong engagement from China to invest actually in manufacturing and kind of factories that are producing some of the high-tech stuff that many Western countries cannot even produce. So solar PV, batteries, EV parts, or whole EV factories. So this is actually quite interesting that the Chinese are not only doing this at home, but also, of course, doing this abroad. There's a number of different reasons why they're doing this. I would say three. Number one, they are actually world-class, and so they have the capacity to invest abroad. Compared to 10 years ago, maybe not so many Chinese companies were world-class. Now these are world-class companies. Second, they need to be closer to their customer. So it's not worth necessarily transporting everything around the world, but you want to be close to your customers. And third, as well, is you're trying to address trade impediments. So these are a lot of private sector engagement in this technology as space, which is quite fascinating. And we're also seeing really kind of new technologies like hydrogen as well, with investments in Nigeria and with investments in Spain, which is again not a BRI country. So there is also really in this very kind of, I think, promising technology space, significant investments around hydrogen. And the third sector is metals and mining, that has really over the last years also taken a much larger share of the Chinese engagement in BRI countries. And so this year, for the first time, we distinguished also a little bit between kind of what is actually kind of mining versus metals processing, because sometimes they're too easily conflated. And about, I think, $10 billion in the first half of 2025 was actually in mining activities, and $16 billion was in processing. So it's quite interesting. So these are by now the largest sectors. Transport, which used to be, again, the second largest sector, has dropped down significantly in terms of its share of the BRI engagement.
And what about telecom? That used to be one of the other major sectors, the digital Silk Road we heard a lot about, and the Beidou satellite system and all these other areas, the Peace cable and so forth. What about telecom?
So we didn't track a lot of telecoms so far. It's telecoms sometimes might also be difficult kind of to associate with one specific country. So, but overall, kind of we're not finding as much telecom we used to. Last year, we had a couple of data centers which saw significant engagement from China, so which is also related to telecom or technology. This year, we couldn't find, our data didn't show any of those. Data are always incomplete, Eric. You know that as well. We're always trying our best, but sometimes we find some other things as well.
Of course. That does go without saying. Anytime we're looking at Chinese data, it's a little bit of piecing things together. But it does seem to me that going forward, this rush to dominate AI is going to promote building of data centers, huge AI data centers around the world, something that we're seeing from OpenAI, we're seeing from Amazon and Microsoft and others to build. I would assume that the Alibabas of the world are also going to be building these huge data centers in BRI countries in the next few years as well.
I could imagine that too. And I think that's also in the interest of some of the BRI countries to actually attract data centers into their countries. It's a challenge, I think, right now, particularly with these massive data centers. Do we have sufficient power?
And water too, yeah.
So that's a challenge for some of the BRI countries. So consistency in power and electricity. It's interesting what we've seen in Pakistan actually this year. And kind of Pakistan has built an overcapacity in some areas of electricity, and so they have struck a deal with the US to provide some electricity for Bitcoin mining, so for cryptocurrencies, and trying to make some money out of that as well.
Okay. Well, I mean, that seems to pair nicely for what the Chinese will do, because if there's a need for power, then I could see Chinese power companies, Power China and others, coming in to build power facilities for data centers. I mean, those two go together nicely.
Yeah, they go together nicely. And I think what's interesting in this space, it is actually relatively quickly built. These are not kind of 10-year projects like even a coal-fired power plant, and even worse, a nuclear plant. Those take decades. If you want to have a data center with green energy, you can actually do it in a relatively short amount of time.
Yeah, 18 months or so, they can get some of these things up and running, and at least the solar part of it. Listen, this was a record year from what your data showed so far, at least in the first half of the year.
It's already a record year. No matter what,
it's already a record year. It beat
no matter what
24
happens,
numbers.
You can lean back in the second half. It's already a record year.
Yeah. Well, what are you expecting? Are we expecting this number to keep just skyrocketing up, or are you expecting things to taper off a little bit in the second half of the year?
I think that's a great question. So I think there is some chance that we've seen these mega deals all happening announced in the first 6 months of 2025, and that we're probably not going to see such mega deals in the second half. But who knows? I think there's still a lot of ambition from Chinese companies to engage in the BRI countries. There's a lot of engagement from BRI countries with China to kind of source for deals. We've seen all these visits by heads of state and other company leaders to China to try to get more investments. And that is not only from BRI countries. Australia was just there with a big delegation last week in China to see kind of what we can do together. So I think there is overall a strong interest. And that, to your point from before, is also driven, I think, by the withdrawal from the US and kind of challenges to the international trade systems. And a stronger interest is like, yes, kind of how can we keep up some of our economic opportunities, whether you're Australia or Kazakhstan or Nigeria, you want to keep up trade, and who are your reliable trade partners, and how can you also deal with the new situation that we have? And so I think there is a strong interest also to attract investment and partnership with all the partners, and China is a big one.
Well, I cannot recommend enough to read this report. It's absolutely essential reading to understand where the Belt and Road is going. And this is a little bit of an enigma for a lot of people. It's very difficult to follow. These reports give you actual data that gives you these insights as to what's happening right now. The report is the China Belt and Road Initiative Investment Report 2025 H1. That's the first half of the year. I've put a link to it in the show notes, and I cannot recommend it enough. It was produced by the folks at Australia's Griffith University and the Green Finance and Development Center in Beijing, led by Christoph Nedopil, who is the director of the Griffith Asia Institute and a professor at Griffith University in Brisbane. Thank you so much, Christoph, for your time. I really appreciate it, and your insights are always so helpful for us to gain a better understanding of what's going on with the BRI.
Great to see you, Eric, and thanks so much for having me again.
Wonderful. And again, want to thank everybody for joining us today. And if you'd like to follow the work that the whole team at CGSP is doing around the world, go to ChinaGlobalSouth.com and you'll see all of the great analysis that they're doing. That we have new data sets coming out, new videos, podcasts. If you want to follow all of the things that they're doing, that Jiho, Lucy, and Cobus are doing, and the rest of the team in Asia, Africa, and the Middle East, go to ChinaGlobalSouth.com. Cobus and I will be back again next week with another episode of the China Global South podcast. Until then, thank you so much for listening and for watching.